Zoom, and we will address those as we go or at the end as time allows. And you will receive one CPE credit as well. And to do so, you must participate in all of the polling questions. My name is Leslie Mondesir, and I am the Marketing and Member Solutions Manager here at the bank. And I am with Drew here, who will introduce himself and get us started.
Thanks, Leslie. Well, good afternoon, everyone, and thanks for joining us today. Again, as Leslie said, we're going to pretty much stick to the same format as we had in our first iteration of this series. This will be hosted quarterly, so feel free to tune in each quarter. We'll be sharing most of the data with you based on call report data, as well as some data that we have internally that that Leslie will share with you insofar as member trends and things that are going on within our district. I'm going to start things off here in a second, talking a little bit about the economy like I did last time. We'll have some reiteration of a few items, few poll questions we're going to re-ask because quite frankly, a lot has changed since May, since we've held this. And that'll help us get an idea of that evolution, the thought process that you have. But be sure to answer those poll questions. Even if you don't need CPE credit, it gives you a good opportunity to see where you stand within your peers within our district, as well as gives us an opportunity to see kind of what your overall gauge is on these particular topics, whether it's the economy, whether it's things that we're doing with you directly as members. So with that, I'm going to open it up to our first poll question today. This is just simply asking whether or not you do need CPE credit on that first question, just a simple yes or no. And that will give us a better way to manage who all needs it, who all does not, and be able to send out those certificates once they're available to you. The second, as you can see, is asking, hey, what are you most excited about or interested in for this particular webinar? Put those answers in the poll there in front of you. If you have any questions or any technical assistance, by all means, use that Q&A and we'll be able to help you out there. I'll allow a little bit more time here to get everyone in on those poll questions. Looks like we've got just about everyone, a few more filtering in here. Okay, I'm going to go ahead and we'll close that poll. Okay, so I know you're not really worried about who needs CPE credits, who doesn't. I know a lot of our CPAs on the call today certainly like to have that any opportunity that they can. Looks like about 30% of you or so are interested in the market and economy update, another 23% in the peer analysis and member trends. And then we've got about almost half the room here today interested in the funding strategies and considerations. So that's great. We will move on with this and begin our discussion on the economy. So, last time we talked a lot about maybe a potential change in the overall environment relative to where we started the year, right? I'd mentioned that we started the year in January with a projected 6 cuts by the Fed. Fast forward to May when we hosted the call, it was looking closer to 1 to 2. And sure enough, that's kind of where the sentiment is within the participations that we had on the call, about 1 to 2 cuts. Inflation since then has continued to improve, just at a relative glacial pace, if you will. We're seeing signs of falling interest rates, of course, in the bond market, but it's that consumer part of the inflation picture that remains pretty sticky. So, that graph over there to your right does a good job explaining just the sheer difference between the buying power of the average consumer in 2019, just 5 years ago, fast forward to today. Really haven't seen that type of inflation blow up as quickly as it did in such times compared to even the late 70s and 80s. So that persists, and we're moving into the elections in November, and that's going to be a very important part of the conversations that we're going to hear from both the Republican and Democratic politicians, whether it's in the House and Senate, or of course what we're hearing from the Harris campaign and from the Trump campaign. So that'll continue to be a major topic of conversation going forward. But the big question is, leading up till maybe this last month or so, will the Fed cut rates? Well, it seems pretty likely that they're telegraphing that they're ready to do so. They have already, and I think in somewhat of an anticipatory move, started to reduce QT, so quantitative tightening. And I think that they're aware that if they start to lower rates, they don't probably want to also double down and really aggressively ramp up QT, right? They want to provide as much stability to the system as they can and not shock the system. So that remains to be seen as to how exactly that ratio works out, QT relative to the rate cuts. GDP just printed this morning, pretty much flat from the last print. From the first estimate, it did increase from 2.8% to 3%. But insofar as quarter over quarter relatively flat, it is down considerably from the all-time highs a couple years ago. Core PCE came in a little lower this morning, quarter over quarter, 2.8%. Core CPI, 3.2%. And these arrows, just keep in mind, I'm putting it in green and red or gray as flat, depending on how we might perceive it, our members might perceive it, right? I think, core PCE, core CPI, these are inflationary indicators, and that does drive GDP. But we've also seen a rise in unemployment lately. In fact, I think that 4.3% print that we got is the highest since 21, late 20. Also, we're seeing home price appreciation come down. That HPI year-over-year index is coming down. It's now at 5.73%, and pending home sales remains very stagnant. In fact, the recent print that we had this morning has it at the lowest pending home sales on record. In this particular statistic, it goes back to 2001. So really, if you take the sort of a 10,000-foot view of this, it's the good, the bad, and the ugly, right? We've got some good things happening with the economy, reduced inflation. It's just happening at a very, very slow pace. Unfortunately, we're also seeing some weakness in the labor market. And I think the ugly part of this picture is the consumer debt side of things, that we're seeing some early signs of weakness when it comes to consumer credit, and I'll talk about that here in a little bit. So I'm going to open up this poll question before we begin with the rest of these econ slides, and it's just the same question we asked last time in May, and we'll compare the differences. How many rate cuts do you expect for the rest of the year? 1 to 2 or 0, 1 to 2, 3 to 4, or more than 4. So I'll let those answers start coming in. Looks like most of you have answered relative to the first poll. Give it a couple more seconds here, and then we'll go ahead and share the results. Okay. Okay. So yeah, the lion's share of you think 1 to 2 cuts. So maybe a cut at their next meeting and one more to round out the rest of the year. About 13% of you feel that there's going to be closer to 3 to 4. None of you think that there's going to be more than 4, and none of you think that there will be 0 rate cuts for the rest of the year. That it's certainly an increase in the number of cuts so far, right? So we were seeing, in our first poll question that we did on this topic back in May, almost everyone said maybe 1, max 2. There's still a good percentage of you that feel that way. If I had to guess, I would guess most of you that answered there are more in the camp of 2 rather than 1. But, you can feel free to share your comments there. But far more of you are now feeling like it's going to be closer to 3 to 4 cuts for the remainder of the year. So a lot has changed in that time frame. All right, so I'll stop sharing that, and we'll move on to a discussion about Fed funds futures. So here we see the Fed fund futures chart via Bloomberg. And sure enough, according to this, they're expecting about 4 cuts by year end. You can see those percentages. That's just the chance in which those nominal cuts there in the yellow column right beside the dates. will happen, the nominal number of cuts, the percentage that those cuts will occur, and the implied rate all the way there to the far right-hand portion of your screen. So, by January, by the end of January, we might see an implied rate of 4%. If that continues, you can kind of scroll down and see where we're going to be more like mid next year, 3.38 implied rate. Still not below 3, still not close to that 2% target. So even if the Fed at this point, let's just assume that they only do 25 basis point rate cuts and that this all comes to fruition, we're going to be well into 2025 before we do reach that mandate of 2%. And that's really just whatever happens with inflation, right? That doesn't necessarily mean that the Fed funds rate will match core PCE, the Fed's preferred measure of inflation, but it certainly suggests that it's going to take some time for them to get close to that on the Fed funds level. So here's a comparison of where we were in January 2021, the beginning of 2021. The pandemic was still very much an impact to the economy. We had a very high degree of stimulus that had been flooded in the system, and it wasn't done yet. But we did still have a normal shaped yield curve. Okay, so that's that dotted yellow line at the bottom of the screen where interest rates were across the Treasury curve. Compare that today, where the green line is. We're still in an inverted curve. We've been in an inverted curve for the longest stretch in history, 700 and some odd days. We breached the longest yield curve inversion duration back in January of this year, and just continue to add to it. I'll touch on that more here in a little bit on the next slide. But what that arrow is suggesting, and this bull steepening, of kind of put back on our Econ 101 hats, and how the shape of the yield curve reacts under different rate environment scenarios, we can see that this inversion, if the Fed starts to lower rates, as the warp screen indicates they will, we'll see the shorter end of the term come down quicker than the longer end. Therefore, rates overall will be coming down, but more exacerbated on the short end than the long end. So far, that's exactly what the bond market is telegraphing, and we can see that in these next few charts. This is the 10s-2s curve. It's just comparing the Treasury 10-year yield to the Treasury 2-year yield. You can see that red line, and that's the duration in which the inversion of the curve, as far as those particular tenors are concerned, has been happening over these last 2.5 years or so. Right now, it's effectively flat. We're only 3 basis points away from even, and it's the closest we've gotten to even since about mid-2022. So we'll see if that gets back to even, at least as far as that measure is concerned, but it's going to take some time as the Fed decides on their monetary policy for the rest of the year. Insofar as the rest of the bond market is concerned, the long end, when we talked about the 10-year Treasury curve last May, we had noted that it had rallied about 60 basis points from its all-time high in 2022. So it effectively took about 2 years of a very slow and range-bound sort of volatility within the longer end bond curve. And, fast forward to today, it's rallied already 84 basis points. So a pretty big swing in a short amount of time relative to what we saw leading up to where those levels were back in May. So to me, and to many economists and strategists out there, that's a way to gauge how the bond market perceives overall inflation over that 10-year period. And sure enough, it's come down drastically in just a few months. As I mentioned earlier, I'm not going to touch on this too much, but second quarter GDP, the second estimate came in at 3%. So still kind of basically where it has been going all the way back to 2000. If you take an average of GDP going all the way back to 2000, it's about 2.2%. Largely that was, drawn down due to the Great Recession, the duration of the Great Recession, and how much slow growth we had during that period. We also had 2 major recessions. We had one again, although it wasn't as long-lived, with the COVID-related impact. But that 3% handle is quite normal over the past couple of decades or so. Okay, core PCE, as I mentioned, 2.8%. The drivers of which still remain in housing. Housing is the biggest component of CPI and PCE, and so the shelter inputs are really what's still driving that price. And again, if inflation is overall sticky, as I mentioned earlier, housing is most certainly very, very sticky. It takes something like the '08 crisis to really truly see home prices on a national level come down materially. Many strategists and analysts and economists out there feel that this time is clearly different than the last time. We weren't doing as much aggressive lending leading up to today, especially when it comes to mortgage lending. So the credit box is tighter, right? The question is, how is the health of the underlying consumer, right? It might not be the mortgage that kills them this time. It might not be falling home prices that kills them this time. It might be death by 1,000 cuts because of overspending through credit cards and auto loans. The number of folks that are out there with $1,000 auto payments is shockingly high. I think it's somewhere upwards of 2/3 or so. So very, very, very much of a big squeeze on the average consumer right now. Unemployment has been very good, really since about beginning of 2022. Unemployment's come way down. The supply in the labor market's been very, very tight, and we've also seen increased wages. However, the recent print in unemployment did increase to the highest levels that we've seen since the fall of 2021. 4.3% is still a very manageable number for the United States economy. There's nothing really wrong with that number, but it could be showing us that there is some loosening in the labor markets. It's not quite as tight, and some industries are starting to show some concerns. You might have seen some of the headlines from Home Depot a couple weeks ago. They're always a good barometer of consumer spending, especially when it comes to home renovations and remodels. And that is likely attributed to just overall inflation, overall, a lot of that building and buying behavior that happened a couple of years ago in the housing market has really come down. People maybe have already done their renovations, and if there are any on the horizon, they've decided, hey, let's put this off for a little bit till things maybe become a little more affordable. Another weak part of the labor market that we noticed is July's non-farm payrolls change. That red bar there that I've highlighted came in at 114,000, and sure enough, it's the lowest print going all the way back till really the gutted impact of the pandemic. So you have to go all the way back to December 2020 to see a negative number. And this is the least positive number we've seen going back some time. So not a rosy picture, but we're not in negative territory. So nothing to, I think, scream, hey, a recession is here. Another part of the economy that, again, driving inflation, very sticky, is housing. And pending home sales came out this morning and printed the lowest number of pending home sales on record. So again, a lot of folks are still on the fence here when it comes to housing. Interest rates are definitely playing a part. Home prices are definitely playing a part. And we've all talked about it when it comes to so much of the housing market is now consolidated into very, very low interest rate homes that were bought at much lower values. So there's going to be less mobility for quite some time for the folks that don't have a need. Now, mobility is interesting because it's something that when it comes to needing to move, a necessity to move, or anything like that, look, consumers can't really dictate those needs that come. So eventually we'll see some housing turnover through that. But right now, that organic level of housing turnover that we've seen in prior cycles is most likely not going to occur. And it'll take some time before that actually impacts home prices. It's very hard if you think about it. If you're trying to sell your house right now, it wasn't too long ago that in your neighborhood, you were seeing other folks sell their homes at record high prices, and you want to get a hold of that. I know, my friends and family that are currently looking for a new home, or maybe their first home, they're running into that. They're the days on the inventory, the days on hand on inventory when it comes to housing, it has been increasing. And what does that mean? That means that if housing prices aren't coming down commensurate to those longer days on hand, then there's a stubbornness from the sellers, right? They want that high price. Eventually they'll capitulate, but right now they're clearly wanting that high price. So there's really just been a real stagnation in overall home sales, whether it's new home sales or existing home sales. Okay, last slide that I'll cover here. And this is, I think, something that has, if there is a catalyst to the next recession, I think it's going to be just overall consumer debt. And you can see it with some of the retail lines out there, specifically in credit cards and autos. This focuses on credit cards, a report that was released a couple weeks ago by the CFPB. No, they're not our favorite folks, but when it comes to some of the regulations that we have to deal with. But either way, some good data to show what's going on when it comes to household debt. So over here to the left, you'll see that the rise in 30-day and 90-day credit card delinquencies is the highest since prior to the '08 crisis. That's pretty telling, right? That's just overall delinquencies on a 30-day and 90-day basis. Both of those metrics are the highest going all the way back to 2005, 2006. To the right, it's the same type of data, specifically for 90 days delinquent, right? That moving into the serious delinquent phase, and broken out by vintage. And what you'll notice is there's a slight typo in there that the delinquencies that are the highest are in actually the 2020 through 2023 vintages. Okay, so we're going all the way to the beginning of the pandemic through last year. Those folks that took out a new credit card that year are the ones that are experiencing the highest degree of defaults. And the takeaway there for me is there was some loosening in credit card standards, clearly. And I think as inflation started to pick up, as demand for more credit started to pick up after the stimulus dollars were drying up, liquidity became a little tighter, not only in, just for financial institutions, but also at the consumer level, right? And so those balances started to decrease. We've seen that. We're at all-time highs on an inflation-adjusted credit card balance perspective, but now we're starting to see this rise in delinquencies, which I think is going to persist, and eventually that will persist into or present itself with folks that are going to be needing to make some either serious changes to their overall buying behavior, which will tamper growth, tamping down growth, and maybe even going so far as to bankruptcies, foreclosures, etc. So with that, I'm going to go ahead and ask this last polling question relative to the economy. And it's the same question we asked before. What's your biggest concern? Is it inflation? Is it housing affordability? Does your institution have quite a bit in that housing space? And you've seen it time and time again. I know a lot of the feedback that I get from my members in Oklahoma is, the home affordability thing is still a problem. So that might be an issue for your institution. Unemployment or rising delinquency. So I'll give you a few more seconds here to answer that. We'll share the poll with you. Okay. All right. Looks like everyone's come in here. Let's share those results. Wow. So, before rising delinquencies was very low on your priorities. In fact, the lowest coupled with unemployment. But right now it's 39% of you. So the majority of you are actually concerned about rising delinquencies. So that's very interesting. Inflation is second on the list. That was absolutely hands down number one on the list just a few months ago. And then housing affordability and fewer folks worried about unemployment. So, and look, let's be honest, unemployment is going to be the last thing to drop here, right? By the time we get to that level of serious unemployment, the recession is well underway. Folks are already unemployed. We're already going to see some cracks in other parts of the economy leading up to that anyway. So that's not surprising, but I am surprised that we have such a large percentage of you concerned about rising delinquencies, because that certainly wasn't the case just a few months ago. All right. With that, I'm going to turn it over to Leslie for some member financial trends. Leslie?
Thank you, Drew, for the economic update. Here we are going to start walking through our second quarter call report trends and talk about what we've seen, kind of change from the first quarter to the second quarter, and what issues are in focus, and then looking forward. So some topics that continue to be kind of top of mind are earnings and margin management, specifically cost of funds for our members, deposit funding environment, persistent headwinds that continue to be challenging to bring in deposits or retain deposits. Economic outlook did change this one a little bit from before. We kind of had a perpetually uncertain kind of outlook, and as the data has kind of evolved over the last few months that Drew talked about, maybe kind of a softening or weakening in the economy has been the trend. I'd also credit containment, that's still kind of lingering out there. And like you just said with your last poll question, the rising in delinquencies. So definitely top of mind. Liquidity, regulators continue to place emphasis on access and stress scenario analysis. Another thing I'd mention as a potential is a slowdown in lending activity due to caution for an economic downturn and tightening credit conditions. We did remove tangible capital positions. Those were on the list before. We've seen some relief there. So we kind of took it off the list for now, as we hear less about it. It seems to be less of a concern as we've moved over these last few months and through 2024. Going into the next slide, we did have a rebound in loan growth for the second quarter, which was kind of an opposite or reverse from what we saw in the first quarter. Cash also, the gray bar. So there, I guess I'll walk through the charts first. This is use of funds, our change quarter over quarter in asset composition. Our bank members are going to be on the left, and credit unions are going to be on the right as we walk through these slides. The dark gray there is going to be your change in cash. The lighter blue is going to be the change in securities. And you can see that there's little activity in the security portfolio movement. And then the dark blue is going to be loan growth. For our bank members, kind of a rebound in loan growth. And then for our credit union members, it's been slowing for well over a year. And then we did see a rebound during the second quarter for our credit union members. For our bank members, that loan growth, it was led primarily again by CRE lending, followed by some 1 to 4 family, C&I, and multifamily. On the credit union side, we did see some growth in HELOC, other real estate, again 1 to 4. And after a pullback in commercial lending last quarter, for our credit union members, we did see some growth in volume there. We'll go to the next slide. So our funding pressures. On the funding side, here's a look at the other side of the balance sheet. Looking at the source of funds, so deposit portfolio and borrowings. You can see there on the far right of each graph, non-maturity deposits. Those did fall, kind of reverse again what happened in the first quarter for our members, both on the bank side and credit union side. That pressure returned, especially for credit unions. Time deposits for both members. We did have an increase again. So we're still seeing that shift in deposit composition from non-maturity deposits into the higher costing term deposits. Borrowings, we did see a growth in advances for the second quarter. That's going to be the gray bar. And then the reliance or use of broker deposits there on the yellow for our bank members that did decline in the second quarter. Will consumers start to save again, or the spending, the stimulus we've received during the pandemic, those savings have been spent? And will members or customers begin to save again? I don't know, with inflationary pressures, again, spending and not saving is continuing. Okay, poll questions. Let's get here. I'm gonna reload polls. All right, our questions here. First question, what is your outlook on competing for deposits for the next 12 to 8 months? And then what are your loan growth expectations? What do those look like for the remainder of 2024 and into 2025? In May, we did ask a question on kind of your thoughts and what you thought deposit balances were going to go for the remainder of 24, and it was majority was flat to minimal growth. So challenging environment is certainly what was reflected in our May polling question related to the deposit front. And it looks like most have answered, so we will end it and share our results. And looks like, yes, and it follows the same theme there on the funding side for sure. Continues to be a very challenging environment and expect that to continue going forward. A few of you either no change or maybe a little bit relief and easier. On the loan side, some moderate growth or minimal loan growth are the two areas where where members are expecting to still see some loan growth. And so maybe the first quarter, this pullback, and maybe the second quarter with some loan growth, maybe we'll continue to see that through the rest of this year and into 2025. Stop sharing those and then move into our funding maturities. As I talked or mentioned with the funding portfolios, how those have switched to a more term deposits when members or when customers were kind of woke up to deposits and banking and became much more aware of deposit pricing a year ago in March with the mini bank crisis. You could see that big shift there beginning in the first quarter of 2023 into term funding, especially the dark blue bars for each member segment. The bank members and credit unions, that dark blue bar, that's going to be retail CDs. You can just see the tremendous growth that you experienced there. And then advances continue to be fairly steady, a solid portion of your funding portfolios, and brokered deposits as well. So the term portion funding of portfolios continued to expand. And as that happened, it was short. The funding was short. And so we continue to have a lot of maturity walls just kind of knocking on the door, which if that's short term, like most of these are, some cut in rates is going to be a relief for cost of funds, especially on the borrowing side where that's going to be reflected a lot quicker. It's more efficient than probably on the retail side with deposits. That pricing tends to lag a little bit on the deposit side. Go to the next slide. Here we have margin headwinds continue to persist for banks, especially credit unions. They continue to expand. Our credit union members have been able to lag a little bit on their deposit pressure or deposit funding costs compared to our bank members. And here on the left, the two charts is net interest margin, which is going to be that navy line, dark blue line, versus cost of interest-bearing deposits, that light blue line, over the last 20 plus years. Cost of funds is going to be the dashed line. And you can see in the prior two cycles, that light yellow shading, that's where the Fed either stopped raising rates or began to cut. And the cost of funds continue to rise for interest-bearing deposits. That has continued through the last couple quarters as the Fed has paused at the top of the cycle. And we expect that to continue in this through this cycle. So as the Fed starts cutting, we still expect to see some pressure on the deposit funding costs. And there on the right for our bank members, I did chart cost of time deposits. So those retail CDs and the activity in those accounts has just continued to grow. And that's also reflected in rate. That dark blue line is going to be time deposits. Went from very cheap and now tend to be priced. And this is the median of all of our member banks, and it now exceeds the cost of borrowings. So it's we expect those deposit costs to continue to rise, and maybe those borrowing costs to come down, especially as members have stayed short for some, and those that have locked in some longer term funding are continuing to see that benefit with that lower cost of borrowings.
You know, one thing I found interesting here, Leslie, is, you know, if you look at this, we've highlighted the recessions here in yellow, right? So in these last two recessions, you can see, and this is a very common thread, even if you're to take it back, many decades earlier, that, you know, the Fed funds rate is always peaking right before the beginning of the next recession, and you see that here with some flatlining before they finally start dropping rates after the fact. The question is, how is it going to work this time, right? We're already starting to see it flatline just a touch, right? And, you know, it's longer than that dash suggests because this is multiple quarters, but, you know, that they've been holding off. But relative to your cost of funds, relative to, you know, when this disparity happens, right, you see this big disparity in Fed funds and cost of funds, and the lag that happens with cost of funds relative to the Fed funds, you know, and what you mentioned earlier is we're probably going to continue to see that cost of funds increase, despite, even while the Fed is lowering rates, right? And in both of these prior instances, we saw that the Fed really had, you know, had been, what, 3, 4, 5, 6 cuts in, maybe more in the 06 and the cut in rates, or the 08 crisis rather, and then moving on over here into 2019 or 2020, the COVID-led recession. Not quite the same story, but I mean, the trend is still the same, but it was such a short-lived recession that you don't see the same kind of data. So yeah, keep an eye on that as you go forward, and try to think tactically about how to maybe get ahead of that. It's not as easy as just saying it, but there might be some ways to anticipate that this might be the next change, and to try to shorten up the duration of those liabilities as much as you can to try to reprice into that new market.
Sure. And then related to the cost of deposits, we just show on the poll questions both a minute ago and then in May, just the funding environment, how much tougher it is. Members or customers are more aware of deposit pricing, and so wanting to retain those customers, that they're will look elsewhere for rates. Right. And so keeping deposit pricing, it's just going to be top of mind, and continue to be important, to look at different deposit funding strategies for the shift in interest rates. Yeah. Whether to retain, let some of those depositors maybe go. Looking at deposit bases, are those funds that came in for the higher rate, is it a one relationship type of account, or is it a relationship where you have a greater share of the wallet? Things to consider as kind of the rate cycle starts to shift. Yeah. All right, and then just one quick slide on credit. The concerns continue to mount. Again, as you noted in the poll question, the rising delinquencies. We've heard from some few members that on auto lending, their delinquencies are on the rise, and there's even voluntary repos. People are coming in and just dropping off their keys. So those credit concerns continue to be around, and consumer stress. There's still focus on CRE exposure, particularly from a regulatory perspective. We have, so we'll continue to keep an eye on that. Net charge-offs are here on the left for banks, credit unions in the blue, trend over about 20+ year period. Same for provisions on the right. Trends between the first and second quarter were very consistent. That 2024 annualized line for both banks and credit unions, provisions and net charge-offs, it was consistent. So there wasn't a lot of movement there, but again, compared to prior periods and coming off such a period of time where credit costs were very low, those numbers, we haven't had a normal credit cycle in a long time. Those numbers are a little bit higher. All right, so on the horizon, some of the things we've talked about, just a slide, the takeaways that we've talked about with share and deposits, the funding portfolios. Drew talked about the pivot and interest rate outlook, and the inflation concerns inflation's on the way down, it seems. Labor market is weakening and the strength of the consumer is not as strong as it once was. Kind of a repeat of our top issues and focus for members with a little bit more detail on looking forward. All right, and then we're going to get into where do we take that and look at some of our advanced products and funding strategies that we have based off some of the market detail and data that we're seeing. So first, we're gonna take a quick look at looking ahead. All signs point to rate cuts. Will the Fed move at a gradual pace down, or will they move quickly in their policy stance? Like your poll question, expect 1 to 2 cuts this year. We'll see Fed meeting here in a couple weeks. We'll get more information on kind of what they're thinking looking forward. Also, we'll see what kind of impact an election may have as well. So when we think about or consider incremental funding needs, what's coming up with maturities, we talked about those maturity walls and the short duration that we have on the retail CDs that are maturing. We have BTFP that's still outstanding and maturing, and advances. Do we look to fund short, or do we extend our funding, or maybe kind of a blending funding strategy between the two? Recent market conditions, they've continued to create challenges, but also opportunities for funding for financial institutions. Interest rate risk profiles, they've swung quite a bit over the last 24 months. And as we shift into maybe an easing cycle, kind of what that might look like. And two components that we can work with together are cost and liquidity, and considerations to look at. And what point on the yield curve can be a function of balancing act between managing interest rate risk and also and liquidity needs, as well as monitoring market conditions. Here on this slide, we do have advanced curve evolution. I added another line, a couple more lines. We had the same chart a few months ago. You can see how the curve really dropped there at 8.5. We saw a lot of activity here at the bank with members extending, and we've still seen that continued, and it's come back up a little bit. You can see the green line there as of August 27th, yesterday, 2 days ago. And there on the right, kind of in the belly, the 5-year advance rate volatility, that's going to be the day-to-day change in the 5-year over the last almost year, just to kind of look at, tell a story of what's there on the advance curve, the shift in advance curves there on the left. And then as we move forward, a few funding strategies to help prepare your institution for success as we look forward and to move into a falling rate environment. Mentioned briefly funding considerations there, riding down the curve and reducing duration to take advantage of some cost savings there as the Fed starts to reduce rates, along with evaluating, we mentioned before, deposit composition and understanding the rate sensitivity of your deposit base as you look to save on that interest expense as we move forward.
And on the asset side, what I always try to kind of do this exercise where I ask myself, if I'm sitting in my member shoes in prior cycles that we were starting to move into a falling rate environment, what would have I done differently? And everybody, if you had that crystal ball, of course, you know what you do, right? You would try to actually extend your liability, or I'm sorry, you're trying to extend your asset duration, trying to lock in yields, knowing that those are going to come down. It's easier said than done. And, you can only do that in certain sectors that are a little bit more flexible, right? The loan portfolio, let's just be honest, it talks back, right? Loan demand is what it is. You can try to drum up as much loans as you can within your risk tolerances, but at the end of the day, it's a supply and demand issue, and it's really not very malleable. The bond portfolio, for those of you that are actively investing or have in prior cycles, a mistake made leading into, you might say, leading into the pandemic, thinking that we were going to go through yet another decades-long recession like we did through the Great Recession, was maybe locking in too many of those yields as they were riding down the curve a little late into it. There's no way to tell, right? There's no really way to tell. But the good thing that you can do on the asset side when it comes to bonds is try to prepare for multiple types of scenarios. So buying, 30-year munis, thinking you have the crystal ball today that interest rates are only going to go down, probably isn't the prudent curve. But an inverted yield curve also tricks you into doing what you shouldn't do, right? Which is, hey, get that highest yield short term, but then, oh no, now I've got reinvestment yields to worry about. So be thinking about that as we move into this next phase of the interest rate cycle. If we are in fact moving lower for longer, ask yourself, what is it going to look like during the last couple of recessions? Is it going to look very quick and fervorous like these last two, which was 2008 crisis? I mean, the sky was truly falling. It was the worst economic crisis since the Great Depression. We thought it was probably going to happen again during COVID. The powers that be were wrong there. A lot of people were wrong there. And it translated into a lot of the inflation that we have today. But if this one's going to be more of a gradual pace, it does buy you some time to make those decisions. But at the same time, we do have to be a little bit tactical with it. So you're looking at reasonable floors on your adjustable rate notes, locking in some fixed asset yields and extend duration when you can. Identify some of the sectors and assets that have the best risk reward relationship. Whether that, if you're a big muni buyer, that has a pretty good risk reward relationships when it comes to defaults relative to the tax equivalent yields that you might have an appetite for. Again, don't go too long with these things, but they can certainly provide good spreads. I know that the muni to treasury ratios, last I looked this morning, were the most attractive they've been in a couple years. So that might be a play for you. Continue to evaluate non-interest revenue sources and improve the overall efficiencies, because if we do move into a recession, before that happens, we're going to see some margin squeezing, right? Those lags that Leslie just pointed out are very much into play. You go back to that last slide that she was pointing out with cost of funds. The cost of funds after the Great Recession didn't even bottom out until the Fed had finally started engaging in the 2019 or the 2016 rather rate hikes, right? And so trying to avoid that as much as you possibly can by skinnying the levels of those peaks and valleys and when they do occur.
All right, so some of the advanced products that we have to help meet some of your balance sheet needs or maybe pain points, some alternatives for you to consider using would be our bullet advance, SOFR adjustable, puttable. Of course, there are others that aren't listed here, like OLOC, and then some strategies to consider as we move forward. They can be utilized together as they each have their own unique characteristics or features for you to consider as you evaluate funding strategies for your institution. And we'll talk about SOFR adjustable advance briefly. We did touch on this one in May, but thought we would include it again, as it provides many of the same repricing benefits of our line of credit, but does afford some of the benefits of longer term liquidity. The index may vary, but the spread when you book the advance, it is fixed for the life of the advance. And you can see that our adjustable, SOFR adjustable, it is one of our most efficiently priced advance products relative to the cost. And you can see on the left there, we have OLOC in the light blue line. The dark blue portion of the 4 right bars is going to be SOFR, and the gray bar or piece of the bar is going to represent the spread. And in this example, that ranges from about 15.5 to 21 basis points. And you can see that benefit there compared to OLOC of 5.54 versus 5.495 for a 3-month SOFR advance. If your institution is consistently rolling an OLOC you have a portion that continues to be outstanding, consider moving a portion of this funding maybe over to the SOFR adjustable. It's a little bit more efficient and can be favorable for some of your liquidity measures with a longer final maturity. And then by keeping some on the line, it'll allow you to still maintain some flexibility if deposits come in, or from cash flows on the asset side. So you still have a little bit of wiggle room and possibility. So for advances, they may also be an attractive funding alternative option for some ag operating lines as well.
Yeah, and that last bullet point that Leslie has there, regarding call options, so if you're, kind of on the fence, maybe I'm anticipating the Fed starting to cut rates, but I just, I'm worried that inflation is just going to rear its ugly head. But let's be honest, we've seen some kind of fits and starts, a lot of, volatility in the inflation kind of space. And we'll get a good couple of, improving prints in inflation. And the next thing you know, boom, something hits, right? In fact, largely the GDP improvement from the initial estimate of 2.8 to 3% is attributed to consumer spending. Is it desperation spending?
Right.
Is it, we really can't get into the aggregate there. But my point is, if you're in the mindset of, look, I'm really on the fence here. We might see rate cuts, but we could get back to an inflationary environment. So the last thing that I would want is a product that's only going to ride the curve. And in this case, if inflation starts to rise again against you, maybe that a call option gives you something in your back pocket to unwind it, right? Say, okay, yeah, the SOFR is going to perform much better in a falling rate environment for me. But if, I'm not, totally convinced, maybe I'd put a call option in there to put in your back pocket to exercise and unwind that if you need it.
Yep. All right, puttables. They continue to remain a popular funding option since we rolled it out in April of last year. Some are extending or using the advances for the lowest cost funding option to relieve margin pressure. There are some that continue to do that. They are very customizable in terms of the option that you have, as well as whether it's a one-time or the Bermudan, which is multiple call options. Here on the right, last quarter, we showed you some pricing comparisons of the advance curve versus a few structures of puttables. Here, what we did is we charted our all the puttables that we have issued since rolling out the product. And you can see the most popular terms there, the kind of more solid lines, if you will, of the 10-year at 120 months and the 5-year, they're the 60 months that have been the most popular. And then we did color code them based off of the first option, whether that was a 3, 6, 12, or greater than 12. There are some 24 and 36 month first call options, or put options, I guess I should say, that are out there. And then we did notate those that had been, or the put option had been exercised with a diamond with a border. And you can see that those issued, a lot of those issued early on, and a good portion there going into the end of last year. Those that option has been exercised. We wanted to share some information on what members were doing, kind of what was most popular. And then just one comment I did want to make about puttables is how it behaves like a CD product almost. When you don't want it to extend, it will extend. And that's part of the extension risk that we have, or that you have with an advance. But if it does extend, you're getting that cost savings for a good period of time in the beginning. And then if rates continue, if they start falling and then continue to fall, eventually your deposit pricing and maybe some other funding sources you'll get some cost savings there, and it complements that funding.
Yeah, I think the thought process that I've heard from members is, if you're just looking at rates, if you're just looking at the rates on a rate sheet, they clearly stand out, yes. Right? And there's a reason for that. Our capital markets folks do a fantastic job pricing it on the market and understanding the risks with these things. Because keep in mind that this is unlike the callable SOFR that we just mentioned, which is the option for you, the member. This option, the puttable, is the option of the Federal Home Loan Bank.
Yes.
And we, of course, have swaps on our back end to make sure that our balance sheet is managed properly to where if that's in the money, we're going to exercise that option as much as just a basis point, right? And to Leslie's point that, and this is just managing interest rate risk in general, right?
Mm-hmm.
Interest rates start to fall, prepays start coming in. I get all this cash flow when I don't want it. Interest rates start to rise. I want all that cash flow when I can't get a hold of it. And this certainly works the same way. I think to me, it's more, this is a great component of the blended funding strategy. If you're willing to kind of move around a little bit more of your products with your funding sources, this is going to zig when the callable SOFR zags,
Yep.
right? This is going to provide you literally the opposite of what the callable SOFR will do. And so putting those both at play gives you an option of rising rate environments. I'm going to do well here. Falling rate environments, I'm going to do well here. Hopefully, in the end, I'm going to look back in my rearview mirror. Maybe I saved a few basis points along the way. Generally, that works best when it comes to diversifying any asset class or liability class. And that's what we've been helping our members navigate over especially these last few months.
And as a tool that we developed to help evaluate these different funding strategies that we've mentioned is a funding strategy tool that we've put together that allows members to evaluate these different advance types through different rate scenarios. So what we do is, in this example here, it's a 36-month puttable, a 3-year, 6-month berm, where we look at the cost of that over the 3 years, which is going to be the green line or the green highlighted bars there on the left-hand side under the funding strategy comparison. And we graph that and look at the cost of a bullet advance, which, as expected, because you're selling us the options, so that rate is going to be lower than the bullet. And then we look at a rolling SOFR advance along with the OLOC funding. And this tool allows you to make assumptions on when you think those rate hikes or rate cuts might happen over the term of the advance, and the magnitude of those rate cuts. And so you can look at the different scenarios and see what impact that might have on those adjustable rate advances versus what a fixed rate advance, whether that's a puttable or bullet, might look like for on your end. So we have this tool that is available for you to request. You can request it through your account manager, or you can also fill out a request form on our member solutions page of the public site. And just for a little bit more context on this example, if you're looking at it, if we get the materials and are going back through them, what we did for the expected rate adjustments is we looked at the Bloomberg work screen or future probabilities of where rates might be going. And then along with the Fed's dot plot for long-term expectations, and kind of use that as our guide for this example. Drew showed a screenshot of it during his economic update, and that was the basis for this example. And of course, we can customize this to play with a lot of different scenarios. Maybe you only cut, and then it holds flat for a while. Or it's something more drastic, and the magnitude is greater on the way down.
Right. Yeah.
So a lot of options to play with this analysis. And then we can provide also, if you're interested or would like to see some long-term rate history for Fed funds, so for various advanced products, we can also provide that to have a little bit different perspective on how rates have performed over time and through different rate cycles.
Yeah, and this is something that we've been talking with members directly, but a little bit more just verbally and walking through these various scenarios. And what we've been doing is very similar to what Leslie is outlined here, right? Where you're taking the final maturity of the puttable, the 3-year, right, and comparing that to the bullet. Okay, let's just say just those two things, right? But then comes in the option. What happens in 6 months? And maybe I compare that to a 6 month. You could also compare that to a 6-month bullet. You could compare that to any other 6-month type of product, and here we're using the rolling 6-month advance. But either way, that or coupled with just rolling overnight with the OLOC, any of this is customizable. Any of the assumptions can be changed, whether it's a cut, a hold, a back to cut, a cut, a hold, a hike. You could do a lot of these, right? And I think that helps give you a framework of the risk analysis across multiple scenarios, feeling comfortable with the unknown of what's coming next.
All right. Well, we'll kind of wrap up some funding strategies. And for the sake of time, I'm going to launch our last poll where we finish up discussing some funding strategies. Let's see here. All right, so we have a couple questions here for you. And has your funding strategy changed with the Fed likely to begin cutting rates? These are multiple choice, specifically for the second one. What is your expected wholesale funding activity for the remainder of 2024 and into 2025? We provide, we at the bank, we're here to provide access to various funding solutions that to meet your needs. And some of the tools that we've developed can help you do some scenario and situational analysis to see what might best fit your institution. And then we're here to help combat margin pressure with the liability side of the balance sheet and your funding options that you have. And it looks like we're still waiting on some response.
Maybe just a few more, but
all right, we'll go ahead and end it. And then look at the results here. Looks like the plan is majority here is to renew shorter on the curve. So reducing that duration for anticipation of some upcoming rate cuts, or plan not to renew upcoming maturities. Then the other side looks like continuing to increase borrowings or utilize advanced funding to help meet those balance sheet needs. We will move into kind of a quick Federal Home Loan Bank update on Capitol Hill with an election coming up.
Yeah, so, talk of the town, right, is the November election. There's been a lot of changes with, especially with the presidential election, with now Harris entering the fray after Biden took his name out of the hat, and that fundamentally changed the landscape. So, it seems like a pretty good toss-up. What I'm just going to talk to you just really briefly is maybe some implications on, if Republicans take back the White House and maybe also the House and Senate, or the Democrats take, what the implications might be for the home loan bank system as a whole. Okay, we've talked to you guys a lot lately about the changes that have happened with the FHFA, that it's become a very politicized regulator. So I wanted to just touch on that to give you an idea, because we get this question a lot. I got it this morning from one of you folks that reached out to me who couldn't attend the webinar today. So I kind of walked them through this slide. And it's pretty clear that if Democrats retain the White House, if the Harris campaign is successful with their strategy and win the presidential election, we will likely have the same director that we've had before with the FHFA, our primary regulator, and maybe some increased scrutiny from there. What their goal has been really under the Biden administration is trying to create a renewed focus of affordable housing. We get that. And within what we can do, we'd love to provide more affordable housing solutions to our members. But the reality is we can't change the trajectory of home prices. We are certainly not a regulator. And we would like the FHFA to have a better understanding as to how the modern FHLB system really operates. And I think, there's some hats off we should make toward the FHLB system as a whole for really getting in front of this as it started to come out, telling our story, how we're not just a home affordability provider, we're a liquidity provider. We provide community needs type services and products. And we're always trying to come up with creative ways to do that. On the flip side, if the Republicans take back control of the White House, it would likely mean a new director of the FHFA, probably less of a regulatory type of focus, as is typically the case with deregulation type of policies within the Republican candidates, and probably, you know, less focus on affordable housing. I'm not saying that that's not a primary goal of the Republican Party. There's many folks out there, but we haven't heard much from the Trump campaign so far of that being the primary focus. I think both parties it should be, right? We need to find out a way to get more folks into affordable homes. But just understand that that's where we stand. So just with those two potential scenarios at play with the impact to the FHLB system, what we wanted to just point out is that, you know, as a whole, we've been very concerned about this politically motivated type of regulator that is the FHFA now. You guys know it is the same thing with the CFPB, right? And we don't want to have those same hassles as much as we can control it. We also believe that, you know, the Congress should really be the ones that dictate our ongoing mission and purpose of the system, not just one appointed regulator. So we don't want to, you know, on that point, we keep pushing back quite a bit on not going back to what, you know, the days of the FHLB when we were a regulator. We don't want to go back to some sort of, even if it's just a proxy regulator, right? We keep telling them we're not in the business to tell our members how to manage their institutions. That is not our job. So we'll continue to, you know, fight for you guys and your needs and what we're going to do going forward. But we're confident in our story that we're telling to the folks on the Hill and how it's going to best impact from a positive perspective our members. So just keep that in mind. Okay, just a little fun question. This is not who you're going to vote for. This is not this is not any sort of political leanings. Just wondering what the room thinks. I mean, do you think it'll be a Trump-Vance vote come November, or do you think it'll be Harris and Walz? Just put in your thoughts there. We'll share the screen. Looks like, boy, you guys jumped on this quick. I'm saying this is the quickest. I think you had it in your mind immediately. There might be some of you that are on the fence, but looks like most of you are coming in here, and we're going to share those results. Yeah, we've got, you know, in our part of the country, it doesn't surprise you probably to see that about 2/3 of you are thinking maybe that the Trump campaign will prevail, with another 34% of you in the Harris campaign. Hey, I didn't have to vote, neither did you. So I'm not going to put in my opinion because I don't have one. I know you know, if there's anything to be expected, I think when it comes to the political spectrum is the unexpected, right? Yeah. And so, you know, with that in mind, you know, keep them, you know, just know that no matter where we go in this political climate, we try to keep our nose out of politics, with the exception of the things that directly benefit our members. And like I said earlier, we'll continue to fight for that. So never a dull moment. These next few months will be certainly interesting, and we'll see how it plays out going forward. Okay, last couple slides here for you folks. I just wanted to, you know, point out our community and grant programs. We've mentioned these before. Most of these have wrapped up for the year. Our affordable housing program, our turnkey suite, which provides down payment assistance programs and things to both first-time homebuyers, and now with our HOPE program doesn't exclude those non-first-time homebuyers. Our community development programs and community housing programs, those continue to thrive. And our recently rolled out initiative for Native American housing. We rolled that out in 2023. It was a resounding success. We ramped it up this year, and we had more applicants. I think the word got out. So for those folks of you, especially my Oklahoma members, we deal with a lot of tribal communities. It you know, just warms the heart to know that we're putting grants into those folks in our communities that need it the most. And sure enough, our Native American brothers and sisters out there certainly need those funds. So we have not awarded this year's NAHI grants, the Native American Housing Initiative grants. The rest have been completed. So I just wanted to kind of focus on what we've done this year funding on turnkey. So the housing specific initiatives. HSP, the down payment assistance program, our kind of baseline program. We've done 12.9 million across 891 households. HSP Plus, which serves some of those under or hard to develop areas, 1.5 million across 58 households. And then our Hope program, which is expanded a lot more broadly, right, and reached out to more folks that just couldn't get a hold of some of these grant programs because they didn't qualify under the HSP. We did 4.2 million in 350 households. One thing I wanted to point out, Hope was a brand new thing this year, and those funds went fast. They went very, very fast. So if you have any questions leading up to next spring,
as you're going through any strategic planning or planning for next year, if the Hope program is something that your customers could benefit from, suggest kind of getting things set up ahead of time so you're ready when those gates open.
So by all means, reach out to myself or any of the rest of the sales team. We'll be happy to help you prep for next year and get some of those funds in your customers' hands. Lastly, this is a slide that our president and CEO, Jeff Kuzbo, has been covering in our regional meetings. We've had 2 of them so far. They were great. Thanks for the folks that came out in Colorado and in Nebraska. We had a great time with you guys. But this is just to remind everyone of our district as a whole. All you guys are doing fantastic work for your local communities. We continue to try to fulfill our dual housing and liquidity mission. And you can see that more than 98% of counties within our district have been impacted by some of these programs and services. So, I know sometimes it feels like drinking from a fire hose because we do a lot, but at the same time, these certainly have helped a lot of our members across our 4-state district, and will continue to do so going forward. Okay.
I will launch this last question. Last 2
questions regarding the housing programs. Just curious for you. We're going to keep this internal for our own purposes of understanding what your needs are, rally with our team members, but just, what are the types of programs that you'd like to see that would most benefit your institution? So, pick whatever you like there. We don't have any sort of lottery winning pass-through option here. It's just anything maybe new or regarding affordable housing programs. If you have any ideas, a lot of our ideas come from you, the member, that, hey, we have a need here, or other banks across the FHLB system, right? So we're always trying to create, innovate, and we want to make sure we're best suiting your needs. So I'll leave that up for a little bit. Just feel free to pepper in your thoughts here as we wrap up. We're here to help you guys. We've got some events coming up, our last 2 regional meetings, and we'd love to have you out. Next up is our Kansas meeting. So if you're on our website, there's that resource center tab. Just click on that. You'll see events. You can see the upcoming dates. The Kansas regional meeting is going to be Tuesday, September 24th. So about a little less than a month out. It'll be at Prairie Band Casino and Resort in, is it Mayetta?
Yes.
Okay. Sometimes I got to be careful. Hey, in Oklahoma, we have things like Miami, and you get it wrong once, and you might be not let in to your members' doors. So that's going to be the 24th of September, and then in Oklahoma, we're going to have ours Wednesday, October 16th. It's going to be at Kicking Bird Golf Club. So for you folks on the call today that are familiar, Kicking Bird is a public course in Edmond, Oklahoma, but they recently poured a ton of money in it. They've got fantastic facilities. I recently played with a member out there, and the golf course is in really, really good shape. And we always try to do our best to get really good venues, great speakers for all of our events this year. So we'd love to have you out. Make sure you register. The link is right there. Keep an eye out for those registration reminders.
Yes.
Register early and often. And if you have any questions, bring out, whoever you'd like at the bank. We welcome your team members that would benefit the most from these types of events and content. So,
and a quick agenda for you is there'll be a Federal Home Loan Bank update from Jeff Kuzbel. Lance Livey, our Chief Business Officer, will also provide an update. Ryan Gilliland, our government and industry relations officer representative. He will provide an election update. So I was at the Colorado regional meeting, and it'll be interesting to see how that evolves between Colorado middle of August to the Oklahoma meeting. This is 3 weeks out from the election. His update should be great. And then we have Matt Harris with Hilltop Securities that will give kind of a liquidity, interest rate presentation. And then we have Russell Evans, who will return for an economic update.
Yeah. So with that, we'll go ahead and again allow you guys to put in any questions that you have to the Q&A screen. You can of course send us emails. Leslie and I's emails in the context slide that we'll share with everyone. Our direct emails for our regional managers here, myself included, there to the left, as well as our general lending, wire services, HCD, MPF, collateral, member credit, you name it, it's all on there. We do everything we can to help you guys. Thank you for attending today, and we very much look forward to seeing you at the next call and at our upcoming regional meetings.
Yes, and don't forget to register for the November FI Live webinar as well. Click a couple more slides. There it is. November 21st at 2 p.m. We hope you will join us back, and we'll talk about any new updates and some third quarter data.
All right. Thanks, everyone.